There's a version of investing where the IRS legally can never touch your money again. Not while it grows, not when you withdraw it, not ever, no matter how large it gets. Most working Americans already have access to this. Almost none of them are actually using it to its full potential. It's called a Roth IRA, and the government caps how much you're allowed to put in every single year. But here's what almost nobody explains clearly. Hitting that cap consistently, year after year, with the right three funds inside it, can realistically turn into something close to $1 million, completely untouched by taxes, ever. So let me ask you something. Have you ever actually maxed out your Roth IRA in a single calendar year, or does life always seem to get in the way before December rolls around? Most people contribute a little here and there, never quite hitting the full limit, and end up leaving a genuinely massive amount of long-term tax-free growth on the table without realizing it. Today, I'm showing you exactly how I'd max out a Roth IRA using just 3 ETFs, and by the end, I'm running the real math on what consistently doing this could actually be worth by the time you retire. This is Monkey Invest, where we break down exactly what these funds hold, what they're built to do, and whether the plan behind them survives real math. No guesswork, just the mechanics and the numbers. Here's how today works. I'm walking through all 3 funds, why each one earns a spot in a maxed-out Roth specifically, and then reverse engineering what consistent contributions could realistically grow into. Stick around through the numbers at the end, because the final figure is bigger than most people expect from something this simple. The Roth IRA contribution limit currently sits at $7,000 a year for most investors under 50. That's the target, $7,000 a year split across 3 funds chosen specifically because of what a Roth rewards most: long, uninterrupted, tax-free growth. The first fund is your core holding, a fund tracking the S&P 500, giving you ownership in 500 of the largest, most established companies in the U.S. economy in a single purchase. This is the steady backbone of the plan. It won't make headlines for explosive short-term gains, but it's the piece of this portfolio doing the most reliable long-term compounding, quarter after quarter, decade after decade. The yield here is modest, sitting around 1.3%, because the real value is in the price growth, not the income. And the ETF handling this job is VOO, the Vanguard S&P 500 ETF. The second fund tilts this plan more aggressively towards growth, which is exactly the kind of holding a Roth IRA is built to reward. This fund concentrates specifically on large-cap growth companies, the businesses reinvesting aggressively into their own expansion rather than paying out dividends. That growth tends to come with more volatility along the way, and more of the eventual return arriving as pure share price appreciation, which would normally be taxed as capital gains the moment you sold in a regular account. Here's a question worth sitting with. If you knew a certain type of investment was going to grow the fastest, but also get taxed the hardest, wouldn't you want to hold it somewhere taxes could never reach it? That's exactly the logic behind this pick. Inside a Roth, all of that growth compounds completely untouched forever. The yield here is even lower than our first fund, typically under 0.5%, because virtually all of the return comes from price growth. And the ETF filling this role is SCHG, the Schwab U.S. Large Cap Growth ETF. Before I show you the third and final fund, I want you to do something. Drop the number 7,000 in the comments if you've actually hit the full Roth contribution limit before. I want to see how many of you are already doing this for real. The third fund pushes even further into growth territory by shifting down the market cap ladder entirely. This fund holds smaller U.S. companies, businesses that haven't yet grown into household names, but that historically have delivered some of the strongest long-term returns of any segment of the market, precisely because they carry more risk and more volatility than their large-cap counterparts. Smaller companies also tend to generate more of their return through price appreciation and less through dividends, which again makes them exactly the kind of holding that benefits most from sitting inside a Roth instead of a taxable account. The yield here sits around 1.3%, but again, that's not really the point of this fund. The growth potential is. And the ETF completing this three-fund plan is VB, the Vanguard Small Cap ETF. All right, let's run the real math, because this is where maxing out a Roth every single year actually proves its power. Say you contribute the full $7,000 every year split across these three funds, and you do that consistently for 30 straight years, averaging a 9% annual return, a reasonable long-term assumption for a growth-tilted, diversified equity portfolio like this one. Using the actual compounding math for a $7,000 annual contribution at 9% over 30 years, that works out to a future value of approximately $954,000. Not a rough estimate pulled from a thumbnail. That's the real result of the future value of an annuity formula applied to a completely realistic contribution amount. And here's the number that actually matters. Every single dollar of that $954,000 comes out in retirement completely tax-free, not tax-deferred, not taxed later at some unknown future rate, permanently untouched by the IRS for the rest of your life. So here's the real question. If $7,000 a year, consistently invested for 30 years, could realistically land you at the edge of $1 million, completely tax-free, what's actually stopping you from hitting that number every single year from now on? For most people, the honest answer isn't the amount itself, it's consistency. Life happens, expenses come up, and the contribution quietly gets skipped one year, then another. But the math above only works if the contributions actually happen year after year, without long gaps. Now, to be fair, these numbers are illustrative, not guaranteed. A 9% average return isn't promised in any single year. Contribution limits do get adjusted over time, and market performance over any real 30-year stretch will look far bumpier than a smooth compounding chart suggests. But the underlying mechanic, growth-heavy assets compounding completely untaxed inside a Roth, holds true regardless of exactly which specific year produces which specific return. So that's the plan. 3 ETFs, one very specific contribution target, and a genuinely achievable path towards a tax-free retirement account worth close to $1 million. One gives you the steady core of the U.S. economy. One tilts the plan towards aggressive growth exactly where a Roth rewards it most. And one pushes even further down into small-cap territory, capturing the kind of long-term growth that would otherwise come with a real tax bill attached. If this gave you an actual number to aim for instead of a vague goal to max out your Roth someday, hit subscribe, because next week I'm showing you exactly what to do if you can't hit the full $7,000 limit yet, and how to prioritize your contributions instead. Before you go, tell me honestly in the comments, have you maxed out your Roth IRA this year? And if not, what's actually stopping you?